Most UK businesses struggle with profit, not because of effort, but because of structure. In this video, I'll explain UK business models properly, not a buzzword, but as a financial system, using input, process, output, and decision. Because once you understand your model, you understand your costs, your risks, and your control. A business model is not a marketing idea. It is the financial architecture of how a business acquires resources, converts them into value, generates revenue, produces profit or not. In management accounting terms, it defines cost behavior, revenue structure, margin profile, risk exposure, and even cash flow timing. If you cannot clearly explain your model, you cannot control it. Simplify this. Input, these determine your cost base. Process, this determines your cost efficiency. Output, this determines your revenue mechanism. And then decision, this determines your profit outcome. A business model is simply how these four stages connect. Let's look at the 5 core UK small business models and let's break this down properly with examples and using the core financial structure as our framework. The first model is a service-based model, and examples of these are consultants, accountants, tradespeople, and even agencies. Looking at the financial structure, if you look at input, it will be something like mainly labor costs. And the process would be time converted into expertise. And then the output would be the invoice per hour or per project. The financial structure would be examples like high gross margin, maybe capacity constraint and profit, depending on utilization rate. The key risks for these are underpricing time and low billable hours. Then we have a section where we can say management decision focus. So at the end of it, we decide, right? At the end of this structure, this finance structure, we decide. And when we decide, we look at things like charge out rates, staff utilization percentage, overhead allocation per hour as well. So if you don't measure utilization, you don't control the profit. In model 2, we'll explore the product or retail model, right? It could be things like e-commerce, wholesalers, or physical shops. The input will be inventory purchase cost. The process will be stock holding and distribution. Output would be sales volume times the selling price. The financial structure will include things like lower margins, volume driven, working capital heavy. And the key risks are stock holding costs or cash tied up in inventory. And at the end, we'll have the decision where the management decision focus, and this will be your gross margin percentage, stock turnover ratio, contribution per unit. Remember, if your stock doesn't move, your cash doesn't move. The next model we are going to focus on is the subscription model. And these are examples of software providers, memberships, online platforms. When we look at the input part of the financial structure, we look at things like technology development, supporting staff, platform costs. The process will be automated delivery, and the output recurring monthly revenue. And then with the financial structure, you'll have high upfront costs, strong long-term margin, and predictable revenue. The key risks are customer churn. Management decision focus would focus on customer acquisition cost, CAC, lifetime value, LTV, and retention rate. In subscription models, retention matters more than sales spikes. In Module 4, we look at asset-based model. Examples of these are your property rentals or equipment leasing. Input will be equivalent to things like a capital investment, process asset management, output rental income. And the financial structure of this will be high capital exposure, stable income, lower operational complexity. And then the key risk will be asset underutilization. Management decision focus will return on capital employed, occupancy rate, maintenance cost control. Year performance is balance sheet driven. Model 5 is your hybrid module. And most UK small businesses are hybrid. So for example, consultancy plus digital products. Then you have retail plus subscription, service plus maintenance contracts. Hybrid modules increase revenue diversity, but they increase complexity. Your reporting must separate cost centers, margin by stream, cash flow by stream. If you mix everything together, you lose visibility. If you want to try this framework with your own business numbers, I've created a free UK model financial map you can fill out as you watch. Why business models fail? Business models fail when pricing ignores cost structure, fixed cost grows faster than revenue, cash flow timing is misunderstood, growth decisions ignore capacity, or the owner does not understand margin logic. This is not a sales issue, it is a structural issue. From the management accounting lens, when I look at a UK business, I ask, what are the fixed versus variable costs? What drives contribution? What is the break-even point? Where is working capital locked? What happens if revenue drops by 20%? That is how you evaluate resilience. That is management accounting thinking. Let's take a look at a small UK marketing agency example. So we've got the revenue, which is £300,000, staff costs, which are £180,000, overheads, which are £60,000. So now we've got a profit of £60,000. On paper, it's profitable, right? But if utilization drops by 15%, revenue falls, staff costs remain fixed, profit disappears. The model is labor dependent. So the real decision is not getting more clients. It is improving pricing, improves utilizations, control overhead growth, diversify revenue model. This is a structural thinking. So here are 5 steps on what I think small business owners should do. In step 1, you will map out your model using input, process, output, right? In step 2, you classify your cost, fixed, variable, semi-variable. Then we calculate the contribution margin. Step 4, you will identify the biggest risk driver. And in step 5, make one structural improvement. That is strategic control. Business success is really about effort. It's about structure. If you understand your business model financially, you control your risk, you control your margin, and you make better decisions. That is what management accounting is designed to do. To make this actionable for your business, grab your free UK business model financial map in the description below. It lets you map your own costs, revenue drivers, and key decisions, just like we did in today's video. If you found this useful, this is exactly what we explore on UK Finance Explained. How UK organizations structure numbers, control costs, and make better financial decisions. Subscribe if you want clear financial thinking without the noise of software tutorials.